All right.
Okay. I think I'm the only one who has not said a prayer yet. So I guess I'll go ahead and take my turn doing this.
Well, you keep doing all the recording, so we figure you're covered.
Oh man, I shouldn't have brought it up then. Okay. Our dear Heavenly Father, we are thankful for this day and we're thankful that we're able to meet together and for the technology that enables us to do so. And we thank thee for this class and BYU Idaho. And please bless that the Spirit will be with us as we are discussing and talking about our case studies, and that we'll be able to learn and grow from each other, and our minds will be enlightened. In the name of Jesus Christ, amen.
Man.
Okay. So we're gonna go over the Brentwood case first.
Yeah.
Okay, so the first question is to vote on what we should do or what Brentwood should do with Zoe's Kitchen. Whether they should do an IPO now, sell to a strategic or financial buyer, or wait and grow the business until it is more valuable before exiting. So I said to wait because I think it'd be better if they waited a little longer before doing an IPO. So I think they should wait at least another like year, maybe 2 years, and then try to do an IPO.
I said wait too. I didn't give a specific time period they should wait, but based on their yearly growth, I mean, if they can continue that, their IPO is going to be that much higher, and they're going to make that much more off of it. So I figure just keep working and growing your business.
Kenny?
So I said, so one of the unique options was to kind of do both, sell a minority stake in Zoe's to a financial sponsor, and then do an IPO within 3 years afterwards. And I kind of like that idea because it's kind of the best of both worlds. It gives the ability to raise some and kind of sell some equity stake, raise some money, as well as, be able to control the business into the IPO and make sure that it doesn't fall apart and cash out at a later date.
Yeah, as far as because we're supposed to take this from the perspective of Brentwood. Yeah, I thought for Brentwood, I was going to say wait as well, and then sell to either strategic or financial buyer. Maybe I was being lazy, but when I read what it takes to do an IPO and how long it takes, I was like, dude, what a bunch of freaking brain damage. So, I mean, from the owner's perspective, the IPO would be cool to do. But since they're like the financial backers, just to have an exit strategy, I could see wanting to just sell it to get your money. And if you waited a little while, there's going to be obviously more growth and better foundation to sell from. So I guess we all kind of said the same thing a little bit.
Yeah.
I had actually forgotten about the option that Kenny had said, because that's actually what I originally thought too when I first read the case. I was like, oh, that's actually going to be the best. Because for Brentwood, it'd be really good to have that IPO on their portfolio or whatever. So they took that company public. But yeah, I agree too that an IPO is more of a headache than I would want ever.
Yeah. And it's always a risk too, like to take the IPO now, if it doesn't really come out like they want it to, or, they release whatever the price is and then it falters after that, then it's, then you look bad. So while the company seems strong, I think they should be a little stronger before doing that.
Yeah.
Yeah, I think so too. I think, what you guys were saying, taking a company public, there's a lot of hands in the cookie jar between the investment banks, attorneys, and everything like that. So, there's a lot of expenses and risk involved if there isn't enough um, demand, I guess, for the IPO from institutional investors. And so, yeah, it talked about reputational risk. If they can't take the company public because there isn't enough interest, then it could really hurt the company. But they did mention that, the legislature passage of the Jobs Act kind of helped mitigate some of the cost or some of the
Risk.
reputational risks
Yeah.
if they decide, because they can do a lot of it privately up until they decide to go public. And so it's not a bad option to go public, but I think like you guys are right. If they wait a little bit, let the company develop, maybe sell a minority stake, um, to get a return on their investment right now, since their strategy is to get out in 6 years, but it still allows the company to develop and grow, and then they can, raise awareness and do an IPO later and get more dinero.
Mhm. Cool. Should we move on to 2?
Heck
Yeah.
yeah.
Why
So,
would they want to exit now?
so wait, we're asking why does he want to exit now?
Or, yeah, why? Yeah, why? Yeah, like why would Brentwood want to be out now?
The one thing that stuck out to me that he had talked about was Noodles and Company is one of Zoe's biggest competitors, and the fact that like they're doing so well isn't very good for Zoe's Kitchen. And so he thinks like he's been in it long enough. That's usually the amount of time that a company like his is in with another company. And so he thinks like pulling out now is really the best bet for him because it's also possible that Zoe's doesn't do well against Noodles and Company. I think.
Yeah, and I think a reason that they might want to exit as well is their strategy as a private equity firm is to only hold their investments for a certain amount of time. They said that their strategy is to hold it for like 6 years and then try and sell it. And so, yeah, you don't want to, and that's kind of the goal of every private equity firm, is to kind of develop a company, and then you're ultimately trying to get a return on your investment. And he sees that right now is a good time, or potentially a good time, where there's a lot of interest drumming up in the business, both from an IPO standpoint as well as a sale of the business to another firm. And so I think that in and of itself, there he can see that he can get a good return right now for his investors, and so that's a good reason to exit.
No.
Sounds good to me.
What are some reasons for holding now?
I think one of the main reasons would be to build more value in the company, or to avoid risk. But they're going to build value for more time, and then it'll be worth more when they do end up exiting. So
I agree.
And then we're supposed to talk about what can go right and what can go wrong in each situation. I know one thing, and I guess it kind of would be under go wrong in the waiting situation, is that they said that the IPO window can close at any point. Like, it's not very reliable on how long it will be that they can get a really good IPO for the company and everything. And so if they're waiting, then their window might close. There might be another recession or anything like that that would cause the IPO value to tank, and then they wouldn't be able to get a good value like they would be possibly able to now if they do wait.
You can't control the stock market.
Yep.
Yep.
And then I guess one
I
thing.
think just the opposite of that too. If they sell it now, they could be selling it for, I mean,
Yeah.
a tenth or worse of what it really could have been worth to them, a little further down the road. So that way, there's there's really technically an unlimited amount of risk loss that they could take, based on the value that could go up. But that's another risk with it.
Yeah. And then the fact that the IPO could go terribly wrong if they do try to do it now.
Mm-hmm. Well, you're not needing me to answer anything. That's what I was going to say for everything you guys said.
Cool. I'm liking this. Let's just keep.
This one's gone pretty easy.
Just keep rolling.
Number 3 is where I was having my problem, is coming up with what the value of the what the worth of the company was. Yeah. So my answers were pretty. Said if it was an IPO, it'd be 21 times whatever revenues or whatever, and then if it was a strategic or financial buyer, it would be 12 times, and if it was strategic buyer, it'd be 9 times. I didn't even put a number down.
I was like, well, was it the spreadsheet? But the spreadsheet's for the other one, so I had no idea how to do that one. I just kind of guessed too, but I had been told in the past, and it might have been, I put that to sell it to just another party would be, it's like 3 to 4 times the revenue. But now that I think about it, that it might be 3 to 4 times the profit, the yearly profit. Is that right? Does that sound right?
So it's earnings before interest, tax, depreciation, and amortization. So in the case study, it said that in a private sale, it would be, you could sell it for anywhere between 8 to 13 times. Your EBITDA is what it's called, but and then it compared to an average current valuation of 21 times trailing. So basically, whatever your earnings before tax, depreciation, and amortization times 21 or times 8 to 13. But then it also said that Darden Restaurants bought another company for 20 times EBITDA. So
that was kind of a fluke, though, right?
Yeah, exactly. So that was kind of an outlier, but you're looking at 8 to 13 times, and then versus the IPO of the current market is trading at 21 times.
But is that based on the most recent year?
Yeah.
Or is that
so you're trailing.
So I was figuring it right, because it was like almost 11 million. So you do like 11 million times 8 or times 9 or whatever.
Exactly. So
okay. So right. I was doing that right. Shoot.
Yeah, that's exactly right. So.
Okay, because I figured it out. I was like, wait, like $90 million for? I'm like, that seems crazy. And then 21 times if it's an IPO, I was like, geez, that's like a buttload of money. But all right, well, I guess I wasn't too far off.
So you were doing that right. Yeah, because it said what they're earning, like their revenue's big, but their earnings were like 11 million. So you just multiply that.
Yeah, what was this, the revenue line? Yeah, revenue was, what was it, 115 million. So, okay. All right, well, now I know. All right, let's see. Well, so obviously the differences in valuation based on who buys the companies can be quite extreme. If it's a strategic or financial, even though it doesn't seem like there's a lot of difference between 8 and 10 times, or 9 and 12 times or whatever, that's still a buttload of money difference. And then obviously if you go IPO, it's, double that almost.
Right.
So why would you guys sell to a financial buyer instead of an IPO?
One of the biggest reasons is the cost for an IPO is super high compared to the cost for a financial buyer. Because with an IPO, you're incurring not only the cost right then and there, but yearly reoccurring costs of lawyers or whatever. But with selling to like a financial buyer or anything like that, it's just like a much smaller cost. And so if you're more worried about the costs than getting a good deal or whatever, or trying to get a good deal, then the costs might be hard to swallow at the time for an IPO. If that made any sense.
Yeah. I'm wondering if though it's almost double the money to go IPO. My whole thing with IPO is always just the risk factor. If it doesn't work out, then the value of your company's screwed. And so even though you're technically getting a valuation of 21 times, long term it could get hurt. So that's why I would. It's also like a bird in the hand too, right? You do a financial buyer, and it's like it's a quick deal. IPO can drag out for a long time.
Yeah.
Yep, exactly.
All right. So do we think we're good on that then?
Yeah.
Okay. So should we move on to Jim Sharpe?
Yeah.
So this is the questions they're asking here are the same ones they asked for the case study.
Oh, yeah. I was trying to remember which one this one was, but I remember.
This one where he bought a company, right?
Yeah.
Yeah, he was shopping around through like 600 different companies and finally narrowed it down to this aluminum company, aluminum extrusions.
So I think from his perspective, he saw it as a good opportunity to get in because, well, number one, the owner wanted out. So usually that can give you a better deal in buying the company. But also I think one big thing for me, if I ever looked to buy a business, would be to kind of notice things that I think are being done wrong or I could do better, and go for it off that, because whatever I can come in and change and make a difference is going to make it more valuable and more profitable. And I think he had a few opportunities to do that it was mentioned at the bottom with the inventory and then the employees and all that. So I think he saw it as a good opportunity and a place he could make some change. That's what I thought.
Yeah, I agree. I mean, in his case, it's interesting that they gave all the different backgrounds that Jim had working with different companies, because those ended up being like the weaknesses that he would have to deal with the company. And so from his perspective, he's like, okay, this guy really doesn't know how to run a business very well. He's made this mistake, and this mistake. I can just restructure a lot of things and probably make it profitable. And it really seemed like the owner was less than interested in like putting forth the effort and making the company like as good as possible. It just didn't have a lot of answers and was just kind of nonchalant about how things were. But I'll tell you, there's a ton of things he could do. I mean, going in there and deunionizing everything first off would save a grip of cash. And then, work on his pricing and relationships with buyers and distributors and even his employees. So there was a lot he could step in on day one and do.
Yep.
We're just like, is everybody watching TV in the background or something?
No, I was just.
Like
There's
we're all
nothing
just
more to
blown
add.
away by how deep your thoughts are.
What'd you say? I couldn't hear you. What did you say?
No, I just said I was just sitting here blown away by how deep your thoughts are on this case.
Oh yeah, they're super deep, man. Deep thoughts, Jack Andy.
No, I'll follow that up and just say real quick. The one, yeah, just like you were saying, it sounds like Jim's organizational expertise are kind of what, like, he's good at operations and and that's what he was looking for, was going for a company that just needed to be organized and become more efficient, that had potential. And he I think you hit it on the head. He just and that's kind of the feeling I got as I read the case. I was like, man, this guy is kind of like, he seems very proud of himself, but very organized and very meticulous. And that's why he was successful in his previous jobs. And so I think, him going in there and restructuring and organizing the business to be more fluid, because the previous owner was kind of disorganized and just, it mentioned that he had hid, company vehicle or his personal vehicles, and ran a lot of personal expenses through the business. So there's a lot of potential there for him to really grow the business.
Mm-hmm. Yeah. I mean, as long as the product is a good product or a viable product, I think he could do really well with that business. He's in a good position to manage it well. So why don't we try to condense 3, 4,
Well, because I was looking at it, we kind of already have. We've already talked about what he should start doing, what he should start changing. So honestly, and I think the main thing, we can just kind of prioritize the things that need to be done first.
Yeah.
And then decide if what he did was correct, like if he bought the right company. So.
Oh, and real quick, how did you like his financial structure in purchasing the venture?
You mean like the 1.4 million, and then figure out the kind of give him the health insurance and stuff? You mean that instead of the 2 million up front?
Yeah, so he didn't have to finance technically $2 million. Like, the owner carried the note on part of it, and was able to work out some
He was 1.4
benefits in lieu of cash and all that kind of stuff. So it makes the $2 million easier to handle,
I think that's always good if you can find something like that in buying a company, because I mean, you're just basically paying another salary, but I don't know. I think it's a good way to go about it, to avoid just taking out a straight loan.
Well, and the other thing too is he owns 100% of the company. So versus taking on partners, and this guy, I think he needs to own 100% of the company. And I think that's a good structure for him, because he knows he can go in and, generate the changes necessary to, pay down his debt. Because once he pays off his debt, if you look at his estimates moving forward, he plans on getting the note paid off within the first 5 years or whatever. And so if he can do that, I mean, it's going to be a cash cow for him, if it goes according to how he's kind of planned it. And so versus bringing on a partner, and then you have to worry about equity partnerships. And so anyway, I think he's smart to do it that way. And in practice, I think it happens a lot where people will finance, takeovers of businesses through owner carryback notes, and then, financing through the bank. So.
Yeah, I agree.
Good question, though. That's interesting stuff.
Yeah. So what was the last one again, Catherine?
Well, so it asks for us to talk about what is priority.
Prioritizing. That's right.
And then if he made the right acquisition.
Are we supposed to like decide, you know, how it asked, like, should he do 250,000 to upgrade that machine, or should he do the renovations to the building? Is that what it's referring to in terms of the prioritizing?
I
Or
think so.
Yeah.
because
So there's
it's
a
just
ton of
asking-
things.
Yeah,
Yeah.
it's just asking what he should start doing for over the next 6-12 months, and then to decide which ones are the most important. So, like, what would we do in the first 6 months, and then what can wait till the next 6 months? And I guess so, yeah, kind of prioritize that way, or with getting rid of the union, or just anything to do with the business, like what he should do first.
I thought out of the gate, he should. I really think he should probably interview the employees and get to know them and kind of get their assessment of how the business has been running and things that should be changed, because they're on the floor doing things, and then immediately get into assessing his pricing structure and relationship structure with distributors, so he can make sure that he's, yeah, because the guy was like checking his financials like once a quarter instead of once a month, so he could probably narrow a lot of cost efficiencies down just in that restructuring right there, and then move on to, getting rid of the union over the next year, maybe doing building improvements over the next 6 months, things like that.
Yeah, I said that he should sit down with each employee and get to know them and make sure they're happy, and if not, make any changes. But also along with that, like set a new like kind of culture to make that everyone's gonna buy into, just to make them work harder and enjoy it more and enjoy working for you. I think that's an important thing as he's going in. And I mean, he renamed it so he can do whatever he wants and change the culture, and now's the time to do that, I think. And then another thing was that I put was to make any changes or fixes to that the raw materials that they were buying.
Mm-hmm.
So. But yeah, all right, cool. Let's go to the assignment.
I
man.
totally agree with everything you guys just said.
Heck yeah. That's what we like.
All right. So do you guys have the assignment up?
Yeah.
Yeah.
That's weird because, are we supposed to? I guess we've always been writing like 1,500 word things. Is that kind of what we're doing again here?
So
Probably
I
2,000
think
on
for
this one.
this one, it's supposed to be closer to 2,000 because it is 2 case studies.
Oh, yeah.
So for one case study, he likes it to be between 1,000 and 15, but closer to 15 because there's 4 or 5 of us. But then whenever there's 2 case studies, he likes it to be closer to 2,000. So 2,000.
Okay.
That's fine though. I mean, 5 questions, we just split them up, and it's 400 words apiece. That's easy.
Yeah. Okay. So, I'll take any one of them. I don't really care one way or the other.
The only one I wouldn't be comfortable with is
3.
oh, I'm looking at the wrong one. Yeah, 3. I don't know 3 very well, so.
I could do 3. I don't care.
Okay, so I'm just trying to see which ones. So number 1 is for Jim Sharpe.
Yeah.
Number 2
is Jim Sharpe.
3 and 4 are Zoes. And 5 is Zoes.
5
Yeah.
is just like a general thing, kind of.
5 is Zoe's, because that was one of the questions.
Yeah, it was one of them, but yeah.
Right, well, I can take 4 or 5.
Yeah, I'm happy to do either 4 or 5 as well. So
Okay, you guys can figure that out.
Okay, so basically then, between Catherine, Kenny, and myself, it's weird saying your name, Catherine, because that's my ex-wife's name. Sorry. Anyway,
Sorry.
Seriously, can you go by your middle name from now on?
My middle name is actually Catherine.
Oh,
oh,
even
thanks a lot. Yeah, I'm a snowflake. You're bothering me. So, okay. So why don't, between Kenny and Catherine and I, we take care of Zoe's, and then Zach, if you want to do 1 or 2, and then
I'll
we'll tell
do
Marshall. Okay. And then
one.
we'll tell Marshall to do number 2.
Yeah, I'll text it to the group right now.
Okay.
Catherine, do you have a preference?
No, not really.
I'll do number 5.
Okay. Okay. Of course you take the easy one. Come
Yeah.
on.
Does that work?
Yeah, that's fine. I'll make it work.
Fine, I'll do 4.
No, it's okay, really.
Well,
Um,
just the differences in valuations, you know.
we don't have to talk about the actual valuations, so it's fine.
No, so I'm talking about the actual valuations, but obviously you get more as an IPO. You know, you get a little bit more in a strategic buy and then less in a financial buy, or vice versa.
All right, I'll do 4.
Okay, so I'll do
Yeah,
5.
I just texted him too and asked him if he's okay doing number 2. So
Okay.
Well, 2's probably the easiest one, so he shouldn't have a.
Well,
Okay,
you gotta make it last for what, 500 words though?
400.
4, yeah.
400.
Uh,
Yeah, he'll be all right. There are lots of points in there, so.
Okay, so and I can start the Google document again.
okay, cool.
By chance, did anyone ask the teacher about the past 2 weeks' grades?
No, I hadn't asked yet. Like, I saw that he graded the Yield X and home plate one, but the rest devices still hasn't been. Well, I mean, I haven't checked as of today.
I haven't seen it.
Look like it's been inputted.
Let me see if it's come in today yet. I'm just like, dude, what takes him? Oh, sorry, this is getting recorded. Yeah, rest devices.
Now.
It's still not. Rest devices still hasn't been graded.
Well, I feel like it's almost that it already has been graded, but he hasn't put it in on accident.
Yeah, I wonder. But like nothing's been graded from. What week are we in? Are we in 7?
Yeah, we're in 7.
Yeah.
It's flying by.
Anyway, okay. Well, so I guess we're good then, right? Everybody's got their assignments.
Yeah.
Yep,
Alrighty. Well, I'm more than happy to turn it in if everybody just wants to get it on the dock.
Okay.
Hold on. Let me. I may need to walk that back.
Too late.
I may not be able to actually. We're going to be at our city fair Saturday, and I probably won't get home till 10 o'clock, which I think is late, right?
We can
No, it's 11. It's due at 11. But someone
Yeah,
else.
that's 11 your time though.
Oh, I don't know what time it is.
I'm Pacific time, so I'm
Where
an
are
hour
you?
behind you guys.
Where do you live?
San Diego.
Oh, okay, cool. Oh, that's nice.
Yeah, that I don't mind it.
Yeah, I wouldn't either.
Except for the politics and the price, it's great.
Okay. Well, I mean, we can always just figure that out once everyone's done writing.
Yeah. Okay. So, all right. Well, I
Cool.
guess that's it then.
Sweet. Well, thanks, guys.
All right. Thanks, guys. Appreciate it.
See ya.
Thanks, Evan.